Hey everyone, it's been a very long time since the last Pitch Room Africa podcast was recorded, and I'm super excited about this particular one. By the way, for those of you who are just catching up with us, this is our season 3, our first podcast, our first season. We shot 56 episodes on every single week for 52 weeks. And then we doubled that with events, in-person events. And then we cut back because it was a lot. We felt like we were running out of guests. But now we're beginning to get our guests back. So ladies and gentlemen, help me welcome my friend, Flo. Hi,
Let's
Flo.
go. Thank you very much for having me. Very, very excited. 10 p.m. Kenyan time, but I'm very, very excited to be having this discussion. Every time we talk off camera, it's always exciting. So happy to bring some of this discussion online.
No, I'm super excited myself. Dude, we're going to go through so many stuff. But before getting to the really
Vamos.
intense thing, for those people who don't know who you are, what is the journey? What is the story of Flo? Who are you?
Sure. Yeah, a quick introduction. Nduwaflorent, both names just a nightmare to pronounce. So I go by Flo, from a very, very tiny country called Burundi. But currently based in Kenya, Nairobi. Came here almost 13 years ago now. In January, it's going to be 13 years ago. Seems like has been a long time. To any Kenyan government official listening to this, you have to give me a passport now. Feel like I'm almost Kenyan. But yeah, I came here, did a bunch of things, but initially worked in the consulting management consulting space, supporting startups. I was fractional CFO for startups across different countries. And because I can speak French, I was mostly covering the Francophone side of Africa. So Cameroon, Mali, Burkina Faso, Senegal. I did that for some time and eventually joined the investment space. Worked for a growth stage fund, which was investing at the time, debt financing in East Africa. I did a few deals in Kenya, Uganda, Rwanda, and also Burundi. I eventually joined after that an early stage climate tech fund out of Denmark, investing from pre-seed to Series A, but mostly focused on climate tech. And then more recently working with early stage pre-seed to Series A, sector agnostic fund, seed label, fully commercial. But yeah, that's really the space I'm in. Early stage investments. On the side, I also do enjoy investments. Very, very passionate about startup. And I feel like this is an opportunity for the continent really to scale. But yeah, happy to help in any way I can. And yeah, really excited to be here.
I mean, so for those of you who he's giving you the official version, Flo is an avid football fan. His team sucks, but what can we say?
Listen now. Huge Liverpool fan. Huge Liverpool fan. As I remember, we are still the champions. I don't know why people are always blaming me. But yeah, tough season right now, but let's see how that goes. But I'm also supported this big country called Sierra Leone. As you can see, I'm wearing
Yes,
the jersey.
yes,
Yes.
yeah, no,
And City did not
absolutely.
push me to wear this. This was my own choice.
Listen, man, you've been very active in the continent.
Hmm.
You've done how many deals did you do this year?
Well, this year I've done like 6 deals. So we don't usually do many deals. We kind of concentrated, choose a few. So yeah,
Yeah, you handpick your founders, and I think
there you
it's
go.
very interesting. I was reading the snapshots. I want us to do like a snapshot review of where the ecosystem is at the moment. I mean, when 2025 started, we have some really big things happening. We have Lemfi who
Hmm.
raised, a lot of money, and then we have our Cross Boundary also raising a lot of money. And we actually felt like this was the year that we're coming out of the nightmare that we had in, last year. What has this year feel like for you as an investor, but also someone who I know is very passionate about founders? What have this year been like for you?
Well, again, I have to say this has been a very positive year. This is, I think, the first time we have increased the number, like the amount of investments dollars since 2023, right? So from 2021 peak, that was really the peak. investments in the VC space have just been decreasing. This year, finally, things are picking up again. Year-on-year growth since that time. So that's really a good and a strong positive. And what happened, we all know what happened really is in the 2020, 2021, with a lot of free capital going around, especially from the US, zero interest rates. A lot of capital came to the continent. But once interest rates went up, it was just really hard to attract investors. We went through this dark phase where a lot of companies went down. Focus went from really, scale to more profitability. And you kind of started seeing, some of the strong companies, establishing themselves, and the ones that are not doing so well kind of disappearing from the scenes. We saw the last couple of years, we have seen a lot of companies going down, not just early stage, even the ones that are, that we thought were established, a couple of examples in Kenya, I think 3 of the 5 biggest fundraisers in the tech ecosystem went down, which is a scary scene to think through about Kenya. But I think this year, I think we are seeing, more great things. By the end of last year, I remember it started actually at the end of last year. Money Point raised the unicorn round, and then this year also double down on that. Lemify is raising. We are seeing a lot of the growth stage opportunities coming through Series A, Series B, and those are the ones that have been announced. I know there are a couple of deals that are also happening behind the scenes. Next year is even going to be bigger. It's not just about the investment, really. It's also about the returns. We're starting to see, proper exits happening on the continent, right? We always talk about the amount invested, but how much are we actually returning to our LPs, to our investors? Questionable. But I think we have started seeing some of that. As a finance in South Africa, go acquire. Those are actually a really good posts I was reading today. The activities are increasing. A lot of the big corporates are, preparing for more M&A activities. Think about Safaricom in Kenya and the likes. I'll say the ecosystem is recovering. It's not obviously what we want to see, but I feel like it's on the right path. So hopefully next year, more good things coming. But as I always say, very, very bullish on the continent. This is where it's happening. So yeah, just give us some time. We're coming.
No, I mean, there was a global slowdown. I think that has been the
Sure.
argument for the longest period.
Mhm.
Global slowdown, but Africa still maintain its, well, we had a reduction, but still we're still able to, when you compare that to other regions, we're still able to say, the positive signs. Even though when you peel off that data a little bit more, it still is very telling. Because how do you compare a market that is doing 200,
Really hard.
300 billion dollar and reducing by $100 billion, and then your market that is barely hitting that $5 billion mark doing, $2 billion. But when you look at that data, it does look like a lot of loss happened on that side. But then when you look at the impacts or the value impact on our side, it's not really
Yeah.
something.
Yeah. If you think about it also, like the amount of capital that has been raised, if you look at amount raised per unicorn created, Africa is actually well positioned, right? Like the amount
Yes.
of capital has been put in the US to generate the number of, true, there are more unicorns than here, but more dollars per unicorn on average. Same for Europe, same for other regions. So I would say Africa has been more efficient in terms of, generating, or creating more big companies. But obviously the land we are in, as you know, the landscape is just so hard, especially in terms of exits, which has been the major critic we have faced previously.
But Flo, let me push back on that with a question, right? What does big company means? Because in the continent today, we still have very few unicorns that were created in total this year. I mean, I understand that the per dollar unicorn, data, but when you look at what other countries or other regions actually produce in terms of unicorn, we are still not a lot. I think this year how many unicorns were able to,
12, yeah.
no, this year alone, it wasn't 12. This year alone,
It's just
I
only
mean,
one year.
total, well, this year we have, I think, it's Money Point,
4.1.
and it's only Money Points, correct?
Yeah.
Yeah. So I understand that efficiency, but also it's important that, we paint the right picture. But I am of the proponent that we should stop chasing unicorns. So that's why I'm pushing back on that. We should build
I'm not sure
more.
about that, but yeah.
I mean,
Okay.
it's good. It's good to have different opinion on these things, right? I
Sure.
believe, and let me give you context of why I think we should stop chasing unicorns. Unicorns, by definition, are hyper growth companies, right?
Mhm.
So the idea basically is not about profitability or even sustainability. We've seen that. It's mostly about how much can a company raise based on whatever requirement an investor sets. This is why you will see a company in Silicon Valley go from pre-seed to Series D, E, F within 6 months, right? It doesn't really mean that it doesn't mean that bottom line profit is significant or it's really, really strong fundamentally, as long as they can prove, like they can test the interest of the investors to prove a point that they can scale very quickly and they have a strong network of big capital pool, of course they can become unicorns. Whereas on the reverse of where I am now is that we have in the continent, we have more than 50 companies in the continent that are doing more than $1 billion in revenue.
Mhm.
Now, I understand that the venture market is quite different from how you build other type of companies, but then they are much more profitable, they are much more sustainable, they are much more localized and entrenched within the fiber of our ecosystem, the fiber of what the African economics is. And so
Mhm.
why do we expect that a startup, why are we obsessed with the idea that our startup should have the same growth trajectory like startup in Silicon Valley? And why does it look like our venture markets should in any way? And for the longest time, I mean, some investors are changing their mindset now, but for the longest time, when venture came into the continent, it's like venture must replicate what exists in Silicon Valley, despite how difficult it is to build in the continent. So that's my argument. I'd like to hear what your argument is.
Yeah, I had to remove my jacket for this one. It's a serious one. A couple of things to break down, right? So, true, to reach unicorn status, most of the time you need to raise a lot of money to get there in a short period of time, right? But eventually there's profitability along the line, right? There's profitability along the line, and if you think about the biggest companies in the world, all of them were just venture backed, really. I think 70% of all the S&P 500 companies, most of the time, came through like the VC model, became venture backed, and then went to the public markets. So yeah, it's a short period of growth, but eventually in the long term, it's a money printing machine. The case for unicorns, we need innovation. We need innovation not just in the US and developed markets. We need innovation even in developing markets. And most of the time, this innovation comes through unicorn, through venture-backed business models. That's what we have seen, right? And because to generate a good, I think it's Peter Thiel who likes to say this, right? Like it's very hard to sustain a cash flow generating machine that will invest back in innovation without capturing a huge part of the market, right? One of the reasons that you really have to grow fast and capture the market is really that you don't want much competition coming your way. Think about the biggest companies. Think about Facebook. Think about all these big giants. They're able to reinvest the money because they have captured the market, right? Like Google, every single year they innovate, bring new products because they have so much better distribution than anyone, print money, and then reinvest all this money in innovation. When you are fighting competition, you don't have time to think about anything. You're just like, oh, my competitor is going to come and take my money, right? So you have to reach a certain scale before you actually become innovative. So same like in Africa. Like think about companies like M-Pesa, Safaricom, right? Can only achieve this kind of innovation at this scale if you are able to like capture a huge bit of the market, almost becoming a monopoly, right? So the case for unicorn and venture backed is always there, right? And I think it's one we should also have in Africa. About the question that you mentioned around, should we now accept, should we now aim for unicorn? Should we aim for uh I have heard the case for 200 million, $300 million exit, 150 million exit. I'll say in the short term, yes, it's just hard to generate unicorn type of exit all at once. So obviously we need to grow to that kind of like exit 100 to 1 million, 1 billion. But For now, it's, we start 250, 200 million, 300 million. But one thing I like to put into in the ring is, something I'm very passionate about is we are not just investing in Africa. We are not just attracting money from investors investing in Africa. We are competing with other places. Like if I go to raise from an American investor, I'm competing with American VCs, American companies. I'm competing with the stock exchange in the US. I'm competing with European who also want to raise, Southeast Asia, Israel, all the other places. People are also raising, right? And just remember, Africa already has a bad connotation. It's already hard to build in Africa. Infrastructure is already a problem over here, right? There's so many challenges that are already existing here. To really convince someone to come here, a commercial investor, I'm not talking about impact investing, which I have strong opinions on, and we can also dive into that later. To really bring that commercial capital here, right, you really, really, really need to have a strong return mandate compared to anyone else in the world. And if you think about it, if I invest in the S&P 500, I invest in the S&P 500 myself. In the long term, I can generate up to 12% IRR. A rate of return of 12%, that's doubling
Yes.
your money every 5 to 7 years. That's
Yes.
not a small thing. Like, it's a lot of money. I'm already rich.
Right.
Well, I really need to take so much risk, right? So if you think
Yeah.
about that, it's just a bit crazy. VC in the US on average generates more than 21%, right? For the big funds, right? That's already very, very high. So if you think about Africa, right? The kind of returns you have to generate, it has to be close to like the 25, 30% net IRR, net rate of return for to attract commercial investors. And if you do the math backwards, right? If I raise let's say I usually say the ideal fund size is around $50 to $75 million fund, right? And I need to generate a 30% rate of return, right? What kind of exit do you really need? It's going to be very, very, you have to return like almost 4 or 5 times your money, right? If I want to return 4 or 5 times my money and I invest 50 million, that's 200 million that I have to return to my investors. And we know the successful exits are going to be very, very few. You really have to get closer to unicorn status really to justify such returns, right? So for me, it's not about do we need unicorns, do we not need unicorns? It's just about practicality. We are competing with the rest of the world, right? And I don't like the idea of bringing capital here just for philanthropy. We're out here helping poor Africans. Bruh, we are also valid
So okay,
builders
I'm
in the
going.
space.
Let's break that down a little bit. So
Sure.
those of you who are just joining the conversation, so primarily what Flo is talking about, this whole impact investment thesis that have been bombarding the continent in the last couple of years. I mean, here's the argument for impact investing. I'm going to make an argument, and this is not my official position. I would say I have almost similar stance like you are.
Let's
But
go.
the argument has been for a very long time that Africans have not created funds to back funds, right? So we have not
True.
used our own capital to
True.
test our innovation, right?
True.
So we have been usually dependent on using others people capital to actually
Yeah.
test whether entrepreneurship
Sure.
and innovation will actually work in the continent. And in essence, we go to the DFIs, we go to other global international organization who are mostly non-profit focused to come to the continent to prove for us
That is can
that are
work.
in
Yeah.
the continent whether entrepreneurship in the venture way or tech entrepreneurship in the venture way actually works. Their mandate is quite different from ours. Their mandate will say, and one of my friends will say this, and it's a ridiculous statement, but I'm going to make it anyway. He will say, an international donor will come and say, this is X amount. I want you to train X frogs to make Y lizard, but ensure that when you're making Y lizard, 10 cockroaches come out of it. And none of those KPIs or metrics that are provided actually is commercialized. And that also ties into our politics and the way we actually,
Yeah.
our politics actually run.
It's all related.
Most
Yeah. That's a very
states
good point. Yeah.
in the continent don't really focus on commercialization of their economy. Most countries are fully donor backed. And when you have a donor backed economy, what that means is you focus more or you become over zealous about hitting donor milestones
Yeah,
than the commercial viability of your economy that actually create wealth. So that's the
makes sense.
argument. That's the argument
Yeah.
of impact. The argument of impact investing is we have not created the avenues wherein Africans actually invest and test these ideas themselves. We depend on other people to come give us their money so we can test whether tech entrepreneurship works in the continent. What is your argument?
Or a couple of things. So you mentioned, I think you mentioned two main important themes here. One is, you think you guys, if you VC guys think that you can make money doing this thing, why don't you approach local investors? We have so many rich people in Africa. Why don't you approach them? So that's the point number one. The point number two is impact investing. Is there alignment between what this charitable requesting and commercial viability, right? So, and I think both of them are actually quite related, but I will start the first one, which is obviously the local high net worth individuals, right? Actually, there's a very good point about, I think Dangote was talking about the other time. Ali Dangote was talking about, people are asking, he was on an interview and he said, if I really wanted to maximize my potential and make as much money as I can, I could invest in Google. I could put most of my money in Google. I could put most of my money in all the tech stocks in the US. They're going to return way more money than all these investments that are giving me headache here in Africa. Right? So why am I doing this, right? So I guess there's also an impact story behind what he's doing. But I'll say that one of the key challenges that we have faced is really just exits. It's traditional. A lot of the high net worth individuals in Africa have made their money, doing actually some of what we like to call the real economy, manufacturing, real estate, buying land, right? Actually the real economy, not tech enabled solutions, right? So when you come to them with these kind of solutions, it just becomes really hard for them to project. How does this going to work, right? What is IP? How am I going to get my money back? You're telling me I'm not profitable? I was profitable from day one. As soon as I started this
Yes,
company, I was
yes,
making money. You are telling me I'm going to make 10 years before I actually
yes.
make money? Like, there's no
And
way.
even
There's
that
no,
you're not sure.
sorry?
Even that you're not sure.
Yeah, it's a long shot. Most likely, more 90% this company will go down. Right? So yeah, it's very hard to relate to this kind of story. But obviously, we know this can create very, very huge returns. Look at the biggest company in Kenya, Safaricom, right? Tech enabled fully. It's not obviously it's not a VC backed business model, but you can tell like the model they followed is really very close to VC. It's cousin to VC, right? It's you pump in a lot of money in a new technology, you acquire a big market, and then later on you start making margins, right? So that's what M-Pesa is basically, right? It's not a traditional VC, but you can make a case for that, right? That's the first thing I want to say, right? But we really need to get to the exits. We really need to get to show examples that this can work. And once you have one or two good examples, people are going to be like, you know what? I'm not going to miss out on the next unicorn, right? I see from one investment I can make 2000x return, 3000x return. I know for my businesses, this is not something I'm able to achieve, right? I'm talking about in terms for my businesses, I'm talking about, percentage increase every year. I'm not talking about 1000x return, right? So that would be very, very attractive. And I think one way to do it is to really start with the key sectors that we think are aligned to what they're already doing. A lot of the high net worth individuals are very much invested in the real estate space. Why don't you actually invest in real estate, solve some of the challenges? I've seen very good solutions in the good tenants. There's a company called Good Tenants in Nigeria. I think that is building in that space, right? Why don't we start in those areas that they're already familiar with, solving for problems they're already solving, that they're already facing, and then growing. Things like manufacturing, right? A lot of these high net worth individuals are highly involved in the manufacturing space, right? Why don't you try to have, we're talking always about energy efficiency, right? Places again like Nigeria where energy is always a problem. Why don't we come up with solutions in that space? I'm not seeing any of that, by the way. CD, and I will tell you why. It's actually related to the second question you mentioned, which is impact investing, right? A lot of the dollars are coming with a certain mandate. It's like, okay, we want you to invest in climate tech, we want you to invest in agriculture, we want you to invest in this. But obviously, this is not aligned to the agenda of the continent, right? Already, we're already seeing misalignment. I don't think climate tech is a huge concern. You and I are Africans. I don't know if that's something we worry about every single. Obviously, it affects us, but it's not a key major concern of our government. So because there's already misalignment, that also creates issues from day one, right? That's number one. Number two, building a company. We're talking about this before we started the podcast. It's the hardest thing ever, man. Like building a company and being successful. Shout out to all the entrepreneurs out there, man. Like that's even if you are selling things on the street, man. Convincing someone to pay for your product is the hardest thing ever. Right? So you have to be fully focused on this one goal, just to survive, just to make it happen. When you start looking at other metrics, you are lost. Right? If you are looking at number of farmers you are helping, if you're looking at carbon whatever you're helping to capture, whatever, you're already lost. Right? It's just going to be very very hard for you to actually build a sustainable business in the long run. Right? So, and I think that's the major argument against impact investing. Right? When someone comes to you and has different objectives in mind, one of them obviously being commercial viability, it it becomes very easy for a founder to avoid the hard work and be like, you know what? I know if I focus on the impact, I will be able to raise more money and try to put on the side the commercial viability. That's why one of the reasons I think Nigeria is doing quite better than Kenya. I think that a lot of free capital has been circulating in Kenya, which has attracted obviously a certain type of entrepreneurs who are very good at this fundraising game, but obviously operationally is not as good. So, and yeah, but Nigeria, which has actually received less capital and less financing side, has been able to position themselves quite well. Obviously, there is a question of market is bigger, solutions like M-Pesa are not existing there, and other arguments. But I think that's also a major argument. That there has been more commercial capital driven towards Nigeria than Kenya, and Kenya has got a lot of the concessional, as we like to call them. That's the sanitized version of impact investing money. But yeah, once you start looking at other metrics, it's gone. It's really gone. It's already misalignment. I used to work also in impact investing, and I can tell you, we have talked to businesses I talk to businesses which are, hundreds and hundreds of millions of dollars in valuation, but 1 or 2 million in revenues, because it's quite easy to raise financing. Because the more you grow, the more maybe farmers, the more impact you are having. But are you actually having any form of commercial sustainability? 100% no. So that's always very problematic. So yeah, that's something we need to fix. Hence why I really moved to the commercial side. More has to be done on that way.
I mean, also, no, yeah, you did it. You did. I think this tied me to something else that we actually saw this year, which was the approach to the type of capital that was raised completely also changed, right? So we saw a lot of debt happening now, rather than the usual equity positions that was happening. I mean, I know you have been a proponent of M&A, but we know that, and I've had other guests on this conversation on the podcast, wherein we actually break down M&A and we realize that most of the M&As that did happen were mostly a rescue mission rather than a commercial mission. And most of them were actually pushed by investors because they want to,
Exit.
spread that risk and, exit.
Yeah.
And so we're not going to talk about M&A because I know you're probably, we'll probably talk about it later down the conversation. I know you're very big on it, but then I want to focus on the debt financing, and how you see that shaping the future of how we raise and how founders raise money in the continent.
Sure. Actually, first investment role I had was in debt financing. So yeah, I think I'm quite comfortable with that topic. It is needed. debt is needed very much, right? On the continent. Again, I know you said M&A later, but a lot of the acquisitions that happen, especially in more developed markets,
Yes.
they're actually debt financed. So if we really want to see more activities on that side, we have to increase debt financing, right? How debt is being used right now, it's being used as a substitute of equity, which I do not agree with at all. Why do you need to raise equity at an earlier stage compared to a later stage? Is a lot of the capital, we talked about the scale that you need to reach for a venture-backed business. You really have to cover a huge part of the market in a short period of time. And the way you do it is every single capital you get, every single piece of cash flow you get is reinvested back in the business. Debt actually is the opposite of that. Debt is you give me money, I invest in whatever I invest in, and I give you back the money with a small interest. That business model is not efficient for highly scalable businesses, especially at the early stage. But a lot of the founders have been pushed in that direction because equity is just so hard to come by right now. Debt is becoming more available. Why not going that way? But that should happen more at the later stage of businesses, right? And I think like companies like MoneyPoint right now, you're saying more and more. Wave actually just, I think earlier this year, Wave is another actually good example. I think they have signed with IFC, but they announced with IFC that they have a debt facility coming through. And it's because they have already captured the market. Now they're able to focus on cash flow and become more efficient with their operations. At the earlier stage, wouldn't recommend at all to founders. Really push for equity investment so that you can double down on the growth without, taking away money from the business. Otherwise, it's a slower growth. It's more riskier, and that also comes with huge responsibilities. Debt investors are not there to joke, man. It's a tough game. Very much focused on margins. Hard to make it work unless you have that kind of scale. So it's good that we are seeing more debt financing, but it should be happening at the later stage. But and again, on the later stage one, I was also talking to a very good friend of mine. She runs a startup in Kenya, and debt financing is very much needed, especially on the M&A side. But again, our banks are still a bit shy, a bit worried to tackle these highly scalable opportunities. But again, it's a phase we have to go through. It's tough, but it's up to us to do it.
Let me ask this question. How do you raise debt? Because raising debt, it's a little bit different from how you will go and raise equity, right? Because with debt, I mean, it's about your ability to pay that back,
Yeah,
more or
cash flow,
less.
yeah.
Yeah. And then on the equity side, it's basically you selling a dream that you will, you know, chase. And for example, if I sell a dream that Flo's team is going to be like top of the Euro this year, we all know that his team is rubbish, but that's like selling, selling that. But on a serious note, because I've worked with a lot of founders and I've seen some really good companies. And in fact, this year I worked with a Series A, Series B company. And I was having a conversation with a founder on debt, right? And there is a lot of complexity around it. It doesn't seem straightforward. So how do you raise debt? And what is the interest rate at which you would advise a founder who is in your portfolio to raise debt?
As low as possible. The interest rate should be as low as possible.
What is
But yeah,
what does possible look like? And
not
I'm
sure.
asking this because
I'll give numbers. It's easier.
yeah, because even
Yeah,
at
yeah.
macro, let me finish this. Even at macroeconomic level, Africa debt, the debt that we take as a nation, the interest rates are usually higher than what
Yeah.
people in other
More developed
countries,
markets. Yeah.
more developed markets. And here's the sad part. The sad part also, our time of return of that payment, it's even
Okay.
shorter. And this is why
Yeah.
Nigeria, Sierra Leone, and more other countries spend most of their budget servicing debt, not
Sure.
paying the debt, just paying debt services than they actually do in investing in things like education, health. So now let's come back to where we are, right? The companies, and one of your portfolio company is getting ready to raise debt. How would you advise them to do it? And what is the smartest way to negotiate the interest rate?
Yeah. So many things comes to my mind. So the first thing is it's expensive to raise debt because of our risk profile, right? Like every single year, every country is given like a rating, like the Moody rating, basically telling this is how much this company is. I don't know if you have heard of triple A, B, like they give a rating to each country, how risky it is to invest in that country.
But it's important for us to define that for people who are listening to the podcast to understand exactly what
Sure.
you're saying.
So the rating is just, it's just a system created by a few institutions so that each country, if an investor really wants to invest in that country, they're comfortable with the level of risk, right? So like triple A is usually that's the best of the top of the top, which is most of the time, high, the developed economies. And if you are if you have a very good rating, which basically means the probability that you pay back the debt is very high. So the risk is very low, and the lower the risk, the lower the interest rate. So that's one. African countries, because of obviously our history, our political instability, and everything else, it just becomes very, very hard to get a very good rating, which in turn, increases the interest rate that we have to pay on our debt financing, right? So that's a reality. That's the reality of things, and we can do that. And also the currency situation. We saw what happened in Nigeria, not just Nigeria, across the continent the last couple of years. The currency fluctuation was just too much. And that also drives the interest rate that you have. Right? Yes, going back to your question, I need to fundraise. I'm a growth tech company, and I now have stable cash flow coming in. Let's say I'm profitable. I'm now profitable, right? And I think I don't want, and I start to think, I don't want to dilute. So basically, the more you raise equity, the more people take ownership in your companies. Your ownership reduces. I don't want my ownership in my company to reduce more and more. So I think I can actually use that at this stage, right? So there are a couple of funds, many funds. So Talanton, which is actually one of my previous employer, um, previous employers, yeah, has a debt facility that they basically use mostly in East Africa and currently trying to expand outside of East Africa, right? So, and there are a couple of funds which are debt very much focused, right? So it's very important to approach them. Most of these funds, they are very much highly specialized. So a fund will basically say, hey, I'm fintech, right? I'm fintech in Southeast Asia. I'm fintech in East Africa. The company I was working for was mostly East Africa, debt financing, US dollar currency in job creation. That was the mandate, right? So it's very, very smart specialized because what happens with debt investors, if I give out 10 loans, right? It's not like VC where I need maybe 90%. Only like one of the 10 loans to perform. All of them have to perform. If you lose money on one investment, it takes like 4 or 5 investments to return just the capital on that money, right? So you gotta be very, very careful. So specializing is the way to go. Choosing a small niche. So if you're a company, just look out what you do and try to focus. Right now, it's very easy, obviously, with ChatGPT and all the AI tools. It's very easy to get a very much customized list of debt providers we can approach. So that's one of the things you have to think through. Another thing you have to think through, which is very important, is this thing called hedging. So what is hedging? How do I explain this in simple, in simple English? Let's say I invest. So let's say I'm a company and I raise debt financing when the USD to Kenyan shilling is at 100. So hedging basically tells me from now till I finish the loan, the rate between USD and Kenyan shilling is going to always be at 100. So you have to pay in case it goes to 200, in case it goes to 300, you have locked in that rate. You have kept that rate at 100. But to lock that rate, there is a certain percentage you have to pay, right? Which depends. I've seen, debt facility go from 20% interest rate to like 40% because of hedging. Right, hedging can be quite expensive, especially if your country has huge currency fluctuation, which can create a lot of trouble. Right, so basically saying the best way to raise debt is actually to raise in local currency, especially in African context. If you are from a country that has high devaluation and high currency fluctuation, try as much as you can to raise in local currency. And that's the best way to do it. In Kenya, the rate should be somewhere around 20 to 25%. Nigeria is a different game, and I've heard 40% and more on the local currency, right? So it depends. But Kenya should be, if you are raising commercial capital, should be around 20 to 25%. If I go back to impact investing, the rates can even be smaller, 5%. DFC, which is the US arm of investing, sometimes gives loans around that rate, right? 5, sometimes even less than 10%. So it depends really on how you negotiate, but you can get very good rates in that kind of setup. Again, we wouldn't recommend. We have already talked about the disadvantages of this. So yeah, that's one. Another thing you should think about when raising debt, there's a very interesting model called back-to-back facility. So basically, if I have raised equity as USD, let's say I've raised dollars, I have raised 10 million as USD. I can go to the bank and say, I don't have any collateral. I don't have any land to give you, but I'll put some of this money down, right? In case I don't pay, take back some of this money. You'll give me a small interest, obviously, so they can give you like a 1 or 2% interest rate on that dollar, and then they'll give you a loan in local currency, based on that collateral, which is the money you have gotten, right. So it's quite interesting because first of all, you're able to reduce the interest rate that you're going to pay. Because you're getting some form of interest from the dollars that are deposited in your account. And then 2, you won't be affected too much by currency fluctuation. The reason for that is you are getting money in local currency, right? So banks are also very much open to this kind of discussion. And yeah, you can really get a good rate because now you have some form of collateral. The banks, for them, is just collateral. What if you lose this money? Where am I going to go back to? Right. So I know I've talked a lot, but that's some of the things you should consider if you're thinking about
No.
it.
In fact, there is something that you mentioned in there that I wanted to bring up. And this is coming from your tweet. So by the way, let me just take a break here and say, everyone, you should go and follow this guy, Flo. We will make sure to put his Twitter handle on here so you can go check it.
Thank you, brother.
You've been very vocal on stablecoin. So, but for those of you who don't know stablecoin, we're going to define what stablecoin is. But there's something that you said about stablecoin that I wanted to,
was it today or yesterday?
Yes, I think this was yesterday. Was it yesterday or today? I think
earlier
it
today, yeah.
On today. So, your argument on stablecoin was that if any founder now is going into stablecoin, they should have at least raised like tons of money, so they are able to easily that mode, because a lot of people are entering into that and the margins are dropping and shrinking, and fragmentation is increasing. In fact, that's your argument. And I've seen a lot of stablecoin conversation, and stablecoin is even more interesting because in the continent, as you know, volatility, majority of our currency is hugely volatile. What that means is, it means that a lot of companies over the period, especially companies that operate in the loan environment or whatever it is, have lost significant amount of their money and their value, and even, generally not being able to give back to investors anything because of that. So firstly, what is stablecoin and why are you so obsessed about it? And why did you now believe that founders should, in fact, raise a lot of money, which you and I know is almost virtually impossible in the continent?
It's possible.
To be able to define, or in fact, I'll change that. What does a lot of money means in terms of like the money that they should raise if they were to be able to go into that stablecoin, especially given your argument on the decreasing in margins and the shrinking and fragmentation in that is increasing in the space as many people flock into this entire concept of stablecoin. But let's start with the definition. What is a stablecoin and what are the applications of that?
Yeah. Let me answer both questions. Stablecoin is just a type of cryptocurrency which the goal of that cryptocurrency is to keep a steady price, right? So if I'm thinking about the dollars, so like USDT, which is the equivalent of a stable coin for US dollar, will stay always at $1. So that kind of helps in terms of currency fluctuation because with stable coin, you're always going to have that $1 throughout the time, right? So owning a stable coin is basically owning like a stable coin that imitates the dollar. It's just basically owning a dollar, right? Very, very much interesting especially for people in countries where there is high variation or high currency fluctuation, because now, if I have my money in stablecoin, tomorrow I'm not going to lose any form of value in my currency. Like a very good example is, I'm from Burundi. I left Burundi more than 10 years ago, but like 5 years ago, the currency was around $1 was around 2,000 Burundian francs. Right now it's at 10,000. So almost just 5 times depreciation in currency in such a short period of time. So if I had 100,000 Burundian francs, that's basically worth 20. Like it has depreciated by 5 times in the same period of time. But if I had kept that money in dollar or in a stable coin that imitates dollar, it could have been stable, right? It could have been the same amount, right? So hence why a lot of these companies building in this space are getting a lot of traction quite easily. And also another key area is that it's easy to actually transfer money using stablecoin, right? It's cryptocurrency, it's digital. It's very fast and very efficient to transfer money across different places. So that's, in simple terms, hopefully not complicated technical terms out there. So that's point number one. Point number two is you mentioned, why do you need to raise a lot of money? A couple of years ago, when we started seeing more companies building in this space, the margins that they were making. So basically, if I move, let's say, X amount of money, I was taking a certain percentage of that. That's what margins basically mean. Like how much of the total value you have transacted do you actually take? Most of the time, like it was 4-5%. Right now, it's literally less than $1, then less than a 1%. So 0.4, 0.5% that you're actually getting on the transaction you make, right? And what happened was you had huge number of players coming into this space, right? It's quite easy to build in this space. So you have a huge number of people coming into this space, and competition increases. And what happens when competition increases? Everyone wants to remain with their clients. Interest rates start going down. Sorry, it starts going the amount you charge, the cost starts going very down, and it will continue going down, right? Because more players are coming into the same space, right? That brings the question: what do you do now in that kind of scenario? It's really, you have to capture the market quite quickly. Just raise a lot of money, go out there, get as many clients as you can, build a strong moat so that it's not easy for anyone else to enter. When you already have huge number of customers, already have a brand, it's easy to reach out. You have, a support system, call centers, customer service that is very, very strong. It becomes very easy for clients to come back to you compared to, like, having very small team. And yeah, so in essence, it's that really, it's not that complicated. As I said in the post, it's not that complicated. Sometimes whoever raises the most money just is going, especially in these places where there is no much competitive advantage, where anyone can build. AI is
Calculate.
another area. Yeah, like AI right now, like you can build something. You and I know how fast you can.
Good. It's a good thing you mentioned AI. It's also a very good thing because I'm going to bring up another tweet that you actually made. Oh, and I want to know what you mean by this. So you said that I mean, we're not going to define AI here. Everybody knows AI. We're all not the applications of AI. So we're not going to go into that. But there's something that was very interesting that you actually mentioned. You believe that companies like Confluent will actually win in, through data ingestion and integration. In
Sure.
Africa, where we all know how fragmented our data is, what does good data mean in practice?
Wow. Okay. That's really, really hard to answer. But I'll say this company we almost invested in, I can't mention their name. Um, what they were basically doing, they were collecting a very unconventional data from different places. And one of the places that I want to highlight is like government offices. Like if you go to like Gabon, agriculture, the Ministry of Agriculture, they have so much information around the agricultural space in that country, but it's just most of the time written on pen and paper, not very much filtered. You are lucky to find it in Excel. It's just very not just Gabon, but like Gabon, just an example, like most African countries. You have all this information that is out there, but just so hard to process in any way. And I think that's a problem that we have faced on the continent. We won't go back. We won't go to talk about the the data, the lack of data actually on the continent, because that's true. There's data is here, but it's just not accessible for anyone. It's with AI. I think that's something we really have to solve, right? Ensuring that data is clean and it's available for most of the players. Fred Sonica and Santec Technologies are doing quite a lot, especially in the healthcare space around ensuring there is accessible data for our governments to make informed decision. A shout out to Monica Pan. I think she's actually working on that. So it's basically ensuring that we have clean data. And I think that's what I was trying to mention in the tweet is, whoever is going to be able, and this is pre-AI. This is even before we start the training, ensuring that data is clean. Scale AI, which was sold to Meta, I think was close to 20 billion acquisition, if I remember. That's what they basically do, ensuring that data is clean, is well ready for companies, for LLMs before they start processing. And we have to be very keen on this because if you don't have the right data, garbage in, garbage out, the kind of models are going to have are not going to be very adequate to our context, right? So I always hear about having the right AI infrastructure for the continent, but before then we really have to have clean data. And I think that's most of the time has to be done in a very archaic or like traditional way, ensuring you collect data, you arrange it. AI can help in this kind of sense, but it's just hard to maintain. It's just hard to do it. It just has to be done the manual way. Clean data is going to be very, very important. Again, another area I'm not seeing a lot of founders building in. If you are a founder building in this space, we'll have to have discussions and hear your
Yeah, I
thoughts.
mean, to be honest, I mean, I've had a few founders that I've worked with who have, consider working in this space. And one of you mentioned something that is very critical, and I want us to unpack that, which is for the longest time as a base, we have, as a continent, be a lot more forward in consuming these new and emerging technologies. We have actually contributed in the supplier side. Unless we fix our data issue, it's very likely that we're going to find ourselves more in the consumer side. I mean, you talk about a marketplace for AI agents, for example, and I am thinking in my head, how many African companies will actually contribute as a supplier in said marketplace than consumers, right? Because for most times, our technology, have not really focused on that foundational level to be able to help us build these technologies out ourselves in a way that makes us supplier. So here's the question that I have, Flo, and I've been giving this a lot of thought. AI, large language models, more specifically, and a whole lot of other, different elements of, different product types or archetypes of this AI, artificial intelligence, have continuously gone from 0 to 1 million in globally, right? I mean, we've seen that. We've seen where it almost felt like it was yesterday that ChatGPT was launched, and now we're at ChatGPT point 5, right? And now we're
Yeah,
hearing, yeah, and here now we're hearing Elon is actually saying that the next evolution of Grok may be as close to AGI as possible, right?
I've
But
been hearing
then
that quite. Yes, so
exactly. But then, I mean, whether that's true or not, it's a statement that is becoming a lot more popular now. So the question that
mm,
I have is we as a continent are still figuring out our use of AI. We're still focusing on the conversation around infrastructure, but like you said, we have a very huge fragmentized data set. And the continent is so unique that our data doesn't sit in one place, right? Our data is almost scattered across different places, across different languages, across different systems. How do we actually fix that? And what does government needs to do to actually fix that fragmentization for private players to now come in and say, okay, let's build the infrastructure to scale our data.
yeah. Very good question. Very packed question. Yeah, government has a role to play, but I think this is also like an area that private sector can play a key role in. So the data piece, I think, yeah, just there's no other way around it, really. And I think, again, innovation can help with this. Startups I know a few startups that are working in this space, so I'm sure going to find more startups building in this space. It's not just about AI, it's also about, the fintech space. It's just so hard to, disburse loans to people over here because, you don't have enough data to actually conduct a creditworthiness assessment for most of these opportunities, right? So I think that's one area we need to really fix. And I think startups encouraging for the government side, it's really encouraging more innovation in that kind of space. So very much, yeah, very much encouraging innovation in that kind of space. Another area is localization, context localization, right? You talked about, languages, you talked about culture, talking to actually a really good company that is, working towards ensuring that there is, local context integrated.
Bamboo AI. I need to drop Bamboo AI there. So it's a startup that I
That's what
work
they are
with.
doing. That's another company I
Incredible,
didn't know.
incredible startup. Yeah.
Yeah, yeah. So basically ensuring that we have the local context, right? And not just in terms of language, but accents, nuances between the different countries, right? So I think that's very, very, very going to be very, very important. And I think that's something we need to build. Otherwise, we're just going to have, westernized solutions that are not adequate for the market and again be left behind in terms of this new wave. But yeah, we have to have strong local yeah, local companies ensuring. And I think there are different layers, right? There is obviously the first layer, which is the chips. We can play the NVIDIA of the world. We can play the second layer is training the LLM, so the OpenAI, the Anthropic of the world. Really, really hard for us to play there. But on top of this layer, what's happening is you have different companies building different products that are specific to certain areas, specific to certain contexts. And I think that's where we can plug in, right? For instance, to be more practical about this is, for instance, if I'm at 11 Lab and I'm working towards, creating the AI for audio, most likely I don't have context around Africa. So I can plug in as company and basically bringing that kind of context, training the LLMs to understand the local context. But again, it goes back behind around the data piece, right? How do you solve for the data piece? There is a lot of data here, very much fragmented. How do you ensure that you have access to this data quite consolidated in a consolidated way and basically use it to train LLM that will in turn plug to whoever is building on top of the OpenAI and Anthropic infrastructure layer, right? So that's what I would say. We have to be very strategic about this. Another key important area that I really want to mention is really around the data centers. It's going to be more efficient to have data centers here in terms of cost, in terms of speed and latency, to have data
Yeah.
centers based locally instead of actually having them in more And it's not just for AI, it's for even for our cloud infrastructure and so on. Seeing more, I think Amazon was investing in South Africa to have one of the biggest data centers. Same for Nigeria, some of the biggest data centers being built here in Africa, right? So we need also to very much be on top of that. Obviously, that also comes on with the discussion we have around debt. Debt should be affordable. These large infrastructure projects most of the time require huge amounts of debt to be executed, right? So another area, I think those three areas are very much key for us to work.
You mentioned something about the builders on the top, right? So one of the things that AI have created, it's something that I've also been looking at very keenly. In fact, I ran a program recently where I was scaling AI companies, and one of the things that I was critical about when designing that program and thinking now, reflecting on that program, is that there's seem to be an oversaturation of solution in the market. AI have made it so much that you know, the competition is aggressive.
Yeah,
There's many app doing or proposing to do almost exactly the same thing. It's very
yeah,
hard to distinguish them all. I'll tell you this and very shamefully say that here, I have maybe about 3 app on my phone that promises to do the same thing, right?
very
And
frustrating.
yeah, and to be honest, I've not opened either of them because it just really get frustrating. But then I'm going to tie that to something you mentioned. You said that there's a founder market illusion, and all know that, and that's what is leading to oversaturation. That's what is making it hard and difficult for people to be able to differentiate modes across this AI, solution that is in the market. And your argument was that, and I'm going to actually quote the tweet here. Your argument was that you believe that a lot of founders should spend time focusing on one customer, iterating around one customer
Yeah,
until that customer starts to pay, and then move on from there. But here's the question that I wanted to ask you when I saw that, right? Which is Africa purchasing power in Africa is very thin. How do you then
yeah.
sep- how do you then separate real demand from forced compromise?
Sorry. So how do you? Sorry, I didn't get your question.
How do you separate real demand from forced compromise? And the forced compromise is I have to do it not because I really need this product, but because I have been bombarded with it so much by the founder that perhaps if I just do 1 month of it, it will get them off my back or something. And that doesn't really equate to real demand because that means your turning rate is going to be very high. And we've also see other example of that is we've seen how acquiring some fintech customer have been acquired, where you give most fintech, refer someone will give you $5, will give you $10, 10 naira, 5 euros, or whatever it is, even though they don't have the money. So they can be able to have a lot of customers on the platform. And then once this customer comes on the platform, they all drop off because the product was not really in demand. Everybody rushed to it because there is supposedly a benefit of them getting $5 or 5 naira or 5 leon if you're from Sierra Leone because you said you were going to give me if I download the app. So how do you
Yeah,
separate
no. Yeah, you just need to get paying customers very early in your
how
journey,
early?
right? What do you mean high? Like
But
very
how
early, like
early?
yeah, like
Like
from
the
day
one.
one. Yeah, you should be actually. Like the best way, in my opinion, to build a startup is to look at a major key pain point that someone has, choose a customer and say, hey, what's the biggest problem right now you have? This is the biggest problem. I can't, they're like, okay, I really want to source my goods from China, but I can't do that. Like, it's so hard for me. It's so fragmented. Okay, I'll tell you, I'll be building this product that will allow you to fix your biggest problem. If someone came to me today and told me, I'm going to fix your biggest problem right now, I will pay for that. I'll pay for that solution.
I mean, it will
A
be
very
very
good example.
difficult. It will be very difficult to build your biggest problem because your team is never going to win. Anyways, I don't want to
Yeah,
digress.
exactly. That's why initially when building a company, you gotta be a consultant for this company, right? You come in as a consultant and say, hey, I want to fix your issue. I want to help you fix your problem, but let me be your consultant. You work closely with this person for a couple of months, whatever amount of time you need, and basically, once you understand this, that's what you build. You build a product in this kind of line, because when you come already with an idea of what to build, you might realize this customer is maybe not facing as a huge problem as you initially thought. Maybe you don't have, maybe they don't have appetite to pay for it. But one key area that has always worked is making money when your customer makes money, right? And I think that's why lending fintech most of the time gets a lot of traction quite early. Lending loans to a company, they start making money with that money. Yeah, they will very much want to pay for my product, right? So ensuring that you unlock either new markets or new opportunities for your customer, that will always be helpful, right? What you have seen that's working in Africa is the consumer type of product, which basically says, hey, I have this subscription, you have to pay every month or every quarter for it. But yeah, there's not much revenue generating activity associated to it, right? It has to be directly correlated to them making more money, with the thin purchasing power that we have over here, extremely hard to justify any single thing that does not unlock more revenues for the founder, right? There's a very good point you mentioned. I don't know how to explain it, but it's PLG versus GTM. So PLG is product-led growth. Initially, at the beginning of your journey, you're going to very much focus on referrals and high adoption without actually spending too much. So product doing all the talking for you. But very soon you will reach a ceiling. And once you reach that ceiling, it's very important to invest in your growth stage, a go-to-market strategy, right? You should not invest in a go-to-market strategy at very, very early stage unless you have already found product market fit and you've tapped into how far product market fit can take you, right? So, yeah. But to go back to your main question, ensure your customer pays from day one, and to ensure that they pay for them more from day one is one, solving the major key problem, and you're helping them make more money.
I mean, Flo, you've been with me for the last hour. It seems like the conversation doesn't want to end because I have loads of questions for you. I promise you, my
You have to
friend.
do a part two now.
I have so many questions for you, but I recognize that you are 2 hours ahead of me in East Africa, and it will be
It's
so unfair
yeah, it's 11 p.m. soon.
to keep you up. And I know that you're one of the few people in the continent that wakes up at 3 a.m. Most of the time because your very bad team doesn't allow you to sleep. But I'm going to let you go. But I have one question, one final question, and it's a
Tell me.
question that I need to ask any investors that I have here today. If you were building a startup, you're not an
Mhm.
investor. If you were building a startup, what would be your approach to fundraising and why?
Traction always speaks for you, right? Like all the best companies I admire in Africa, they don't do much talking. Numbers do the talking for them. They come to you, they say, hey, this is how much revenues we have. This is the growth. This is the market that is untapped. We have only captured 2-3% right now of the market, right? This is a huge opportunity. Do you want to put your money here? Yes or no?
But
Investors
how
most of the
does
time,
but how does a pre-seed company capture traction without money? Have
yeah,
significant traction without money?
you can get good traction. You can go, especially right now where with AI and when you can build with minimum tools and minimum team. I think it's quite possible to do so. But again, going back to what I've just said, if you are solving a major pain point for your customers, that's one, right? And you are improving their revenues and improving the money they make, it's going to be quite straightforward for you uh, for you to get a bit of traction that will take you to the next step, right? You don't have to get 10 million in revenues. You don't need to get huge amounts of revenues at the initial stage, but it's just showing that, hey, there is a market here. We are growing quite fast in this market. Do you want to join us in the journey? Traction always speaks for yourself. And I think And especially right now when it's becoming, obviously, as I mentioned at the beginning, things are getting better. But obviously, the African fundraising journey is never, it's harder here than anywhere else in the world. Traction always helps you, always speaks for you.
Amazing, my friend. It's been a privilege to have you, to host you. But we have to come back for another episode because clearly
Anytime I
a
pull
lot
up
with
my jersey and
yes,
we do a part
yes,
two.
yes, yes. Please make sure the next time you come and bring it on again because incredible, incredible. It's been a privilege to host you, Flo. Like
Same.
always, your conversation always brings a lot of education to me. And I'm sure those of you who are listening would love to connect with Flo. I will make sure all of the details to his LinkedIn and you can pitch him on their official website. And if you're one of the lucky guys, hopefully you get to make it into Flo's portfolio in 2026. Until next time,
Let's
I've been your
go.
host, Sidi Sakona. I've
All
been
right.
joined by the amazing Florent. Thank you so much for joining, my friend.
Cheers, man. Nice seeing you.